Manoj Ladwa is a senior trader at ETX Capital here in London. He joins us now from his offices in the city. Great to have you on the program, Manoj. First of all, let's talk about the rally that we saw over the last couple of days. Is it already over?
Well, I think so, Lindsay. It's a bit of a shame when the ECB or central banks take these measures and we see the market move up for a day and the next morning, and then it starts to fizzle back out again and the market comes back down again. It's probably the wrong time of year to be expecting a massive move higher in the market, but this is traditionally a strong week in the market, and you tend to find that stocks move higher going into Christmas. So the fact that the market moved down yesterday despite the ECB's measures just reflects how weak investor confidence is. You're
not reading much into it then? You don't think there's new or fresh cause for optimism? Is that what you're saying?
Well, ultimately, is how that money is going to be deployed. 523 banks access close to €500 billion, and if they use that money to shore up their capital base and not lend it out to businesses or individuals and households, then that money is literally of no use, and it just goes to support the banking industry and delay the inevitable, which is ultimately that sovereign debt is a major issue, and is likely to remain a major issue for the foreseeable future.
With that in mind, what happens to European banking stocks in 2012?
Well, I feel that they continue to remain volatile, certainly for the first half of the year. And if you're trading the markets, then you play defensively for the first half of the year, because that volatility could still be there. Sovereign debt is still a major issue. And it's likely that with Greece paying out close to, well, just above 30% on its 10-year debt, that Greece could finally turn around and say, look, enough's enough, and we're going to exit this mechanism and default on some of our debt. That will only add to the volatility, and I feel it could happen in the first 6 months. But then asset prices could become very cheap after the summer, and there could be some interesting bargains out there.
So it's the second half of the year when you're expecting some sort of uplift in the markets.
Absolutely, and it's from that point of view where you'd probably look to switch out of the defensive sectors, such as the pharmaceuticals and the stocks that have been holding up fairly well despite everything that's going on.
All right,
and look to switch back into cyclicals.
Let's get a bit specific. Name some of those stocks that you're going to be looking to get into, and when.
Well, certainly the insurance sector, it's been dragged down with the financial sector on the back of this sovereign debt crisis. And if you're looking at the FTSE 100, then you're looking at the likes of Aviva, Prudential, Royal Sun Alliance, stocks which have fantastic income, great exposure to emerging markets, and are likely to weather any future volatility.
We hear about property prices on the way down in London, grim predictions. But it's pretty resilient, isn't it? I mean, as an investor, would you be putting your money into property next year?
I think you still have to be wary about investing in property. Transactions, as we well know, the last few years have slowed, and it's one of the main reasons why property prices have been sticky and they haven't really fallen. But things are coming to a head at the moment. It's down to the wealth effect, and it's down to how investors and businesses feel about the economy. And as that confidence reduces, ultimately property prices are likely to come down. With unemployment stuck at exceedingly high levels, it's having a negative effect on property prices, and ultimately on the rental market as well, which has been doing fantastically well over the last couple of years.
But when it comes to London, isn't it the foreign buyer that will prop up the market once again?
Absolutely, but then if the foreign buyers are coming from Europe and Europe is struggling, then there's going to be less and less of that money coming over here. If China hard lands instead of soft lands, then there's going to be, again, less of that money coming over here. So London is not immune to what is going on across the globe.
What does it mean for shares in the sector? Are you going to be buying them, selling them, holding them?
Well, the share prices of the house builders have come down quite sharply in the last couple of years anyway, and they seem to be bottoming out certainly in the last 6 months or so. So they do look attractive around here, but then we could find that they move higher and they start to move back down again as property prices again come back down. But I do feel there is limited downside to these share prices, and as a longer term hold, they don't look too bad around here.
Manoj Ladwa, thank you very much for being with us.